On the heels of the U.S. immigration deal with Mexico, this morning President Trump predicted great cooperation between the two nations, while warning that without it, we can always go back to our previous position of tariffs.
So the threat of new tariffs on Mexican imports is gone for now, but maybe not for good. But either way, many people remain fearful of another recession, and some are actually predicting a major market drop on the horizon. Yet, some people are more optimistic. They believe we're in a bull market and that the Dow will continue to rise and maybe even hit the 40,000 mark. We'll explore both ideas over the course of today and next week's show, featuring commentary from pundits from both sides. We'll provide you with all the information that you need to make up your own mind and to protect yourself no matter what the future might hold. It's that time again, time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies in new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategies strives to set new standards and bring institutional-style investing to your portfolio. As you might recall, we devoted an entire show to growing warning signs of recession as recently as February. But, as has been typical throughout the Trump presidency, so many new developments occur almost daily. So, we're revisiting this idea of an impending recession right here today on the show. Then next week, we'll talk about the opposite idea, the idea that we might possibly be in a bull market, and that the economy is thriving, and that we might even see the Dow Jones Industrial Average hit 40,000 points sooner rather than later. Now, as regular viewers of the show know, one of the most significant changes we've seen recently is that the yield curve has actually become inverted in certain parts, giving us one of the most historically accurate indicators of an impending recession. With the yield curve inverted last month and President Trump's trade war escalating again, Wall Street reeled, posting its worst May in 9 years. But does all that inevitably spell recession, the next major sustained market collapse? We're going to be breaking it down for you today on the show and tell you what you need to know to protect yourself. Joining me will be Mark Faber, editor and publisher of the Gloom, Boom, and Doom Report. Plus, financial educator and advisor David McAdams will be joining us. He's the president of McAdams Group in Memphis, Tennessee. Of course, we also want to hear from you. Will the trade war with China, President Trump's tariffs, and a disappointing job report lead the U.S. economy into a recession? Or will the Federal Reserve's monetary policy help propel the economy and stock market to new highs? Send us your thoughts by visiting theincomegeneration.com. But first, let's take a closer look at some of the most recent developments that have rekindled fears of recession. After a fairly calm first 4 months of the year, the stock market took a sharp downturn in May. The Dow Jones Industrial Average fell below 25,000 for the first time since January, and the S&P 500 finished the month down about 6.5%. Overall, it was Wall Street's worst May since 2010, before rebounding again in early June. Now, as we already mentioned, the fear among big investors was driven mainly by trade. President Trump once again ramped up his trade war with China, then closed the month with a threat to impose new tariffs on Mexican imports, a threat that lasted less than a week before it was rescinded. Well, if it all felt like deja vu all over again, that's because in 2018, just about every month was a lot like May of 2019. All year, uncertainty over the impact of escalating trade war was offset by strong economic data, causing big investors to appear optimistic one day and terrified the next. The result? Record market volatility for most of 2018. Now, things were much calmer this year, or at least until May, despite no real progress in resolving the trade war, and despite the appearance of new warning signs for the markets and the economy. The main warning sign, as I mentioned, was the flattening or inversion of parts of the yield curve, which occurs when long-term interest rates fall even with or lower than short-term interest rates. Now, Our regular viewers know that I've been forecasting the likelihood and the potential danger of a flat yield curve for the past several years. So the fact that it finally happened wasn't really a surprise to me, but as I've explained at the time and several times in the past, the way it happened was indeed quite shocking. Now, as you might recall, on March 20th, the Federal Reserve announced it was lowering the number of short-term interest rate hikes it intended to approve this year from at least 2 all the way down to 0. On my 2019 market forecast show, I predicted the Fed would approve no more than 1 rate increase this year, and possibly 0. Why? Because another one of my predictions was that long-term interest rates would continue to hit a strong resistance level or glass ceiling right around the 3% mark. That meant with the federal funds rate already at 2.5% when the year started, any additional rate hikes would risk flattening the yield curve. So I really wasn't surprised by the Fed's announcement, but I was shocked by another announcement made in the same statement, in that the Federal Reserve was planning to discontinue its, quote, unwinding of quantitative easing. When? By September of this year. Now, as I explained it at that time, to me this secondary announcement was basically the same as the Fed announcing that it was intentionally trying to flatten the yield curve. Why? Well, because remember, there are only 2 possible ways the Fed could create a flat yield curve. One, by raising short-term interest rates too high, or number 2, by manipulating long-term interest rates downward until they're even with or lower than short-term rates. Also remember that the whole QE unwinding effort was meant to manipulate long-term rates upward by selling back bonds that the Federal Reserve had purchased during 3 rounds of quantitative easing. By stopping this process, the Fed is basically saying that it will now stop increasing the supply of bonds, which means if demand stays the same, then prices have to rise and yields have to come down on the long-term end of the yield curve. And it doesn't take long for that to start happening. In fact, within days of the March 20 announcement, the yield on the 10-year Treasury rate dropped by 30 basis points. That's 0.3%. And long-term rates across Europe fell as well. As of now, the yield on the 10-year Treasury rate is down in the low 2% range, less than 2.1 on many days, while 2-year yields at 1.85, and the Fed funds rate, again, remains at a full 2.5%. And that is the shortest interest rate that exists really in our country, that Fed funds rate. As I've explained many times, a flat or inverted yield curve can create a major disincentive for banks and other lending institutions to approve loans. Borrowing along with spending is obviously an essential driver of economic growth. And already some big banks are reporting the inverted yield curve is hurting top-line growth and forcing them to scale back earnings forecasts for 2019. The situation is likely to hit small banks even harder. Now, although some experts are downplaying its significance based upon the old argument, this time it'll be different, historically, a flat yield curve is one of the most reliable indicators of recession, and most economists are taking this one seriously. Now, according to a new report by the National Association of Business Economics, a survey of economists said that they believe a recession will hit by the end of 2020, with about half of them saying they believe it might begin halfway through the next year. That is, in the first half of the next year. Among the reasons they cite are not just the inverted yield curve, but also diminishing returns from the Trump administration's tax cuts, and especially the growing impact of his trade policies on businesses and consumers. We'll talk more about that coming up in just a bit. Now it's time to bring in Mark Faber, editor and publisher of the Gloom, Boom, and Doom Report, available at gloomboomdoom.com. So, Mark, tell us, is it recession or not a recession? Which is it?
Well, as you know, an economy is a very complex animal, and there are different sectors in an economy. So you could have a recession in some sectors of the economy and an expansion in other sectors. And that's the way I would also look at China. But in general, if you measure peak economic activity up to now, we're off peak economic activity, which occurred, say, in September, October last year. Right. And since then, there has been a remarkable slowdown. And if we look at trade figures around the world, which are a fairly good indicator of economic activity, in Asia, all countries have declining exports with the exception of India and Vietnam. So that tells you a little bit about the world and how it's slowed down. You look at semiconductor sales, you look at car sales around the world, and you look at the trucking index, the Cass freight index, stocks like FedEx or UPS, how they perform. I'd say we are basically in a recession already. But you understand, government statistics are painting a rosy picture.
Sure.
The bond market is also telling you that we are essentially in a recession.
Yeah. So it's interesting that, obviously being a bond guy, I agree with that, and I see that first. And to me, it amazed me what happened back in December with interest rates. It seemed like that last hike in interest rates that the Federal Reserve made, basically the bond market said, enough, we're not happy with this. And it's almost like the bond market alone finally made the Federal Reserve change policy. Did you see that the same way?
Sure. It's very interesting what is happening in the bond market. But you understand the bond market is very distorted, in particular outside the US, where you have $10 trillion worth of bonds having a negative yield.
Sure.
When I grew up in the 70s, as you know, we had at the time a rising interest rate structure when interest rates on T-bonds went to over 15%. I could never, this is the one thing I would never have dreamt in my life, to have negative interest rates.
Sure. So let me ask you, do you think during the next recession, which I assume if you feel like we're there now, that you probably agree that the media will finally start to have to admit it by, let's say, 2020, as many economists are now predicting. But do you think whenever that next official recession hits, will we go into negative interest rate territory this time here in the United States?
Well, that I don't know, because the situation is again very complex. Assuming interest rates in the US go down further, and just to give you an idea, we have in Italy bond yields that are not meaningfully higher than in the US. In the US, the bond yield is now 2.2% on the 10 years. In Italy, it's 2.10%.
I know.
In Spain, it's 0.39%. In Portugal, it's 0.54%. In Greece, it's 2.45%, so not much higher than in the US. So we have huge distortions.
And Greece should be close to 10% if you think about it with their situation. And some of these other countries should be much higher. So we need to take a quick commercial break, Mark. So please stay with us. We'll be right back in a moment. I want to hear more about that. And you stay with us too. We're here on The Income Generation. I'm Dave Scranton, and we'll be right back. Before we talk more about why the Trump administration's expanding trade war has actually renewed these fears of recession, let's review. First of all, so what is a recession? In simple terms, a recession occurs when the economy stops growing and starts shrinking. Now that sounds simple enough, but as we've explained on our last look at this topic, there are different ways to define growth and different ways to define shrinkage. Some might say a recession is official when the gross domestic product declines for 2 straight quarters. Others might have a broader view. The National Bureau of Economic Research, for example, defines a recession as a significant decline in economic activity that is widespread and that lasts several months. So their definition includes not only a shrinking GDP, but also shrinking incomes, employment, industrial production, retail sales, and so on. But no matter how you define the word recession, there's little debate that a recession can negatively impact every aspect of the economy and sometimes do long-lasting damage. Our last recession, the so-called Great Recession, is a classic example. Although GDP growth did rebound from negative 2.8% at the start of the recession to a positive 2.5% within about a year and a half or so, other impacts actually dragged on for much longer. For several years, unemployment remained high and real estate values remained low. And wage growth has only recently begun to rebound. As for the stock market, if you're a regular viewer, you know that I believe the market has been out of whack with economic fundamentals for the last 10 years, thanks to the Federal Reserve's reckless overuse of artificial stimulus, aka quantitative easing, all supposedly in response to the financial crisis and the Great Recession. Now, in addition to ultimately causing the inverted yield curve, as I discussed in the last segment, the Fed's policies have created a stock market supported more by artificial influences than by economic realities. Influences like quantitative easing abroad, record increasing in stock buybacks, as well as the Fed's continued attempts to manipulate bond yields. Considering all these factors, is it any wonder that the last escalation of Trump's trade war with China has Wall Street and so many economists absolutely worried? Many see it as the last thing that we need right now, economically speaking. Yet, we're getting it anyway. In May, the White House bumped the tariff rate on $200 billion of Chinese imports from 10 to 25%, drawing a similar response against American goods from Beijing. Companies ranging from manufacturers like Deere and Polaris to microchip and toolmaker Snap-on have all denounced the move and warned that it could impact their business. And even though the number of companies publicly criticizing the trade war remains relatively small, economists say those businesses likely represent a much larger number of American companies that will suffer. Now, as is always the case, their suffering will ultimately be passed on to consumers in the form of higher prices, creating an increased obstacle to spending at a time when the inverted yield curve is already creating an obstacle to borrowing. Then, of course, President Trump temporarily threatened to slap 5% tariffs on all Mexican imports and says that he may reimpose the threat if Mexico fails to live up to the terms of a new immigration deal. So please understand that China and Mexico are two of the three largest trading partners of the U.S. last year. The U.S. and Mexico exchanged $612 billion in goods, including oil, autos, computers, fruits, and vegetables. Millions of U.S. jobs are directly or indirectly tied to trade with Mexico. In a worst-case scenario, these trade fights could raise the cost of countless goods for consumers and businesses, and actually trigger a broader economic slowdown and add to inflation. Now, jobs could also be lost, potentially. And as if that weren't bad enough, the latest escalation of the trade war comes on the heels of some new economic data that already shows U.S. profits and economic growth at increasing risk. A recent survey from the financial data firm IHS Markit showed that manufacturing activity fell to a 9-year low in May. That report also revealed what they called a notable slowdown in the U.S. services sector, which is a key area for the American economy. May also saw the Labor Department release a new disappointing report on jobs growth. Again, is it any wonder the stock market is volatile again and more experts are issuing fresh warnings about the next recession? Well, just last month, economists from Morgan Stanley went on record as saying the economy is on recession watch and lowered their second quarter GDP forecast from 1 down to 0.6%. And that came shortly after JP Morgan cut its own second quarter GDP forecast from 2.25% all the way down to 1%. But what about the Federal Reserve's role in all of this? Well, we've already discussed the role of the Fed and the role they played in helping create the current situation. But now the question becomes, can they do anything to help avert a new recession and another major stock market crash? We'll be focusing on this coming up in just a bit. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. And it's that time once again to bring back in Mark Faber, editor and publisher of the Gloom, Boom, and Doom Report. So Mark, you feel like we're in recession. We talked about all the interest rates around the world being ridiculously low, some a lot lower than ours, and arguably they shouldn't be. But, how much of the recession that we're starting to see now, or the recessionary signals that we're starting to see now here in the United States, are due to the actions of the Federal Reserve itself?
I do not think that the Federal Reserve bears any responsibility. On the contrary, the US Fed under Powell has been, and I emphasize this, relatively cautious and relatively responsible compared to the other central banks around the world. The problem we have today is that the asset markets are grossly inflated. People talk about inflation and they measure consumer prices and so forth. But inflation is a manifestation of excessive monetary growth. And it can happen in wages, it can happen in commodities, it can happen in asset prices or consumer prices. Since 1981 up to today, we had a colossal, and I repeat, a colossal asset inflation with some interruptions. But basically, if you remember when you were young and you wanted to buy something, what the price was for a house, for a painting, for equities, for bonds, and what they are today. We have inflated asset markets.
Right.
And these inflated asset markets, once they no longer inflate, they'll produce a recession. Mm-hmm. So it's not the real economy that impacts the asset markets or the stock market. It's a stock market, the property market, the asset markets in general that have an impact on real economic activity.
So Mark, in the 1 minute or so we have left in this segment, tell our income generation viewers, in your opinion, although the Fed seems to be doing a lot right, you seem to feel that way, and that's good. I'm glad to hear that. But do you believe that they've taken on a third mandate, essentially? And that third mandate is keeping Wall Street happy.
Yeah, I'm not sure they want to keep Wall Street happy, but I think some people at the Fed begin to realize that they created a Dracula, a monster that is now so big. How do you contain it? How do you prevent the stock market from collapsing? How do you prevent bonds from collapsing? Corporate bonds, government bonds, they can be manipulated, but corporate bonds are more difficult. And the stock market, as we've seen in Japan and in other parts of the world, in Japan, the BOJ buys equities through ETFs. I think eventually the Fed will also buy equities if the market goes down by more than 15%.
Well, and I think that's fine if they just come out and admit that that's what they're doing. The only troubles that I have is, everybody says, well, that's not our mandate, we don't care, but the actions to me seem to say something different. So we need to come back for one more segment, take a quick commercial break. Stay with us, please, Mark. And you stay with us, too. We'll be right back here with more on the Income Generation. I'm David Scranton, and we'll be back in a moment. In the past, you may have heard me compare the Federal Reserve's current predicament to that of a pilot trying to land an untested experimental aircraft. Why? Because many of the Fed's actions and policies in the last 10 years have been indeed experimental and completely unprecedented. We've never had a Fed so willing to rely on quantitative easing without considering the long-term consequences. We've never had a Fed more interested in keeping Wall Street happy than in getting the economy back to a place where artificial stimulus is an extreme measure instead of standard operating procedure. And that's what has become essentially SOP, standard operating procedure, not just here in the US either, but globally, which is why I often refer to this moment in history as a new age of economic uncertainty. What's happening now with the inverted yield curve and the escalating trade war only adds to this uncertainty. Think of it as a gusty wind or a thick fog, making it harder for this experimental airplane to land. It's the last thing that pilot needs. It's the last thing the economy and financial markets need at this time. But if you think the Fed's going to acknowledge any of this, or that it's going to announce new policies aimed at realigning the markets with reality and getting the economy back on its own 2 feet, well, I would encourage you to think again. In fact, all the Fed's recent 2-day Chicago strategy conference, it laid the groundwork for the use of more quantitative easing to combat the next recession. And this, according to various reports. Adam Posen, president of Peterson Institute for International Economics, told MarketWatch the Fed's strategy includes, quote, pretty aggressive, desperate measures, close quote. Then he added, if you thought you saw quantitative easing before, this is going to be QE squared. Now, to me, as one who has likened the Fed's use of easing to an athlete abusing steroids, that sounds extremely frightening. But it's also not really surprising if you think about it. One of the dangers of overusing an artificial stimulant is that it becomes addictive. That addiction means the user ultimately has little choice, or thinks he has little choice, but to keep using, just to remain functional. And as the body or the economy gets more dependent on the stimulus, its effectiveness decreases. Higher and higher doses actually produce lower and lower results. It becomes a vicious cycle of increasing costs for diminishing returns. Now that may sound a bit dramatic, but I do believe it's a fitting analogy for the problem that the Fed has created for itself, and which I forecast from the very, very beginning. I actually predicted the Fed would resort to increasingly desperate artificial stimulus tactics as far back in 2008 in a newsletter to my clients. I actually foresaw this dangerous road of QE addiction from the beginning. So even though it's disturbing, I can't say the Fed's recent talk of using more aggressive QE measures to counter the next recession surprises me one bit. In some ways, they really do have little choice at this point in time. Now, I've already talked about the Fed's efforts to manipulate long-term interest rates upward with the unwinding of quantitative easing. They were eager to do that not only to avoid an inverted yield curve, but to give themselves some ammunition to lower interest rates again once the next recession hit. In the past, the Fed's been able to slash rates by up to 5% to help stimulate the economy during bad times. But with short-term rates still no higher than 2.5%, that doesn't really give them much room to lower rates that far. That leaves asset purchasing, the main component of quantitative easing, as its main go-to strategy. Which isn't to say the Fed won't cut rates again as part of the broader effort. In fact, as recession fears have mounted in recent months, the Fed's already feeling pressure to cut rates this year in anticipation of more quantitative easing. That pressure is coming partially from all the issues that we've been talking about. Escalating trade war, signs of slowing growth, inverted yield curve, which ironically, many of which the Fed have created. But at this point, it's being driven less by economic fundamentals than by, you guessed it, than by Wall Street. The thinking is that if the Fed's steroids can keep the stock market propped up for 10 years following one of the worst recessions in American history, they might just be able to keep the party going right through another recession. You've heard me talk about the wealth effect, this idea that people are willing to spend because psychologically they feel wealthier. When the market's up, their 401ks are doing well. The question becomes, could the wealth effect created by more Federal Reserve trickery help prevent or at least minimize the next recession? Anything's possible. Personally, though, I'll trust 200 years of stock market history over that, which says that ultimately the markets have to make fundamental sense again. That would likely mean another major market correction to coincide with the next recession, somewhere in the range of 40 to 70%. Again, in the all-new age of economic uncertainty, anything is possible. But if you're within 10 years of retirement, the question becomes, do you really want to take all that risk? Because you don't have to. And we'll be talking about that more coming up in just a bit. And now it's time to bring back for one last segment Mark Faber, editor, publisher of the Gloom, Boom, and Doom report, available at gloomboomdoom.com. So, okay, you think we're in a recession, although economists don't seem to be admitting it yet. Maybe they'll catch up with you and me next year and finally admit it. But can the Federal Reserve, through this asset inflation, if you will, keep the stock market relatively healthy, even if we do go into a recession? Is it a different world now in that regard?
Yes, that is possible, but I'd like to point out what I insinuated before. You understand? The dollar has a value against other currencies and against hard currencies such as gold and possibly bitcoins and so forth. If the Fed eases aggressively, I would expect the dollar to tumble. The dollar at this level, by any means, is overvalued. And if the dollar goes down, then the buyers of bonds would want to be compensated for the potential or the ongoing depreciation of the dollar. So even if the Fed eases, I'm not 100% sure that interest rates on long US bonds will go much lower. Now, can they go and test the lows of 2016 when the 10 years Treasury note was at 1.37%? Possible. May even go to 1%. As I said, in Europe, we have these very low interest rates compared to US rates. And I'd rather own a US Treasury than, say, Portuguese bonds. You understand?
Of course. But let me ask you this, though. If the dollar does weaken, isn't that going to drive foreign investment into our currency, into our bonds, and essentially bring back equilibrium?
Well, who knows? I mean, I think if the dollar weakens, as was the case in the 70s, we could have a pickup in inflation and we could have a flight out of US dollars, because don't forget, I'm a European insurance company. I'm a European billionaire. I see interest rates in Europe. I see interest rates in the US. I'm tempted to buy US bonds simply for the yield pickup, as well as a Japanese institution with negative interest rates in Japan will be essentially tempted to buy US bonds. Once the dollar goes and becomes weak, that money will flow out of US dollars, and that could have an impact on the capital market in the US. But look, I am the first one to admit we don't know how and when it will unravel. But we are in a very artificial situation, and it's unlikely to end well.
You know, it's funny. I always say, when you have a laboratory experiment, sometimes you get a great result, and sometimes a lab experiment ends up in an explosion. And this is ultimately the biggest economic laboratory experiment we've had in the history of our country. So you and I could sit here and jawbone about this, and I love your humility in that you say, hey, we really don't know. And that is the reality. We really don't know. Time will tell. But I think you'll agree that it's time for investors to at least be cautious. So, Mark, I want to thank you so much for your time today.
It's the greatest experiment in the history of your country. It's the greatest experiment in economics in the history of humankind.
In the history of the world. That's right.
Before have interest rates been this low.
That's right. And listen, Mark, we need to leave it there. Unfortunately, we're out of time. It's been my pleasure having you back on the show. Thank you so much.
Thank you so much.
And you stay with us. We'll be right back here on The Income Generation with more. I'm David Scranton. We'll be back in a moment. If you're a regular viewer, you may have heard me say that the bond market is often considered to be smarter than the stock market when it comes to reading economic signals and forecasting trends. We saw a good example of that back in December. That's when the Fed approved its last short-term interest rate hike and was still saying it planned to raise rates 2 or 3 more times in 2019. Throughout most of last year, each time the Fed announced a new short-term rate hike, bond yields, long-term bond yields, would spike slightly, giving the Fed just enough room to raise short-term rates without flattening the yield curve. It was as if the bond market was saying that it agreed the economy was strong enough to handle higher borrowing costs. But all that changed in the month of December. That's when the bond market essentially said, enough is enough. This time, bond yields didn't rise after the Fed's announcement. Yet the Fed went ahead with the December rate hike anyway. The result was a yield curve that was nearly flat right away and got progressively flatter as the new year went on. Then, as we discussed, it became inverted in early May and has remained partially inverted ever since. In other words, it seems in retrospect that all these rekindled worries and warning signs of the next recession are things the bond market foresaw as far back as December. And not only did they foresee it, but also paid attention to it. Unlike the stock market, which, as we've discussed, is guided more by artificial factors than by economic realities. It's guided more by so-called animal spirits in this age of quantitative easing. So, what does all this mean for everyday investors, specifically those who are retired or within 10 years of retirement? Well, if you've already lowered your stock market risk and made the important paradigm shift away from growth-based financial strategies toward actively managed income-based strategies, then it probably doesn't mean very much. It doesn't mean much because the whole point of investing for income is that it reduces your monthly risk and increases your financial security, even in high uncertain times, such as these. It doesn't mean much because with active management, income specialists work to maximize your return, even in a challenging environment of overall low interest rates like the one we're in right now. If, on the other hand, you haven't yet made that paradigm shift and you're still investing more for growth than income, well, in that case, all these increasing worries and warning signs of recession and another major stock market correction could definitely mean a lot to you. At the very least, reviewing your portfolio to assess your risk level with the help of an advisor who specializes in income-based strategies might not be the worst idea at all. In fact, might be an excellent idea. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. Now it's time to welcome our next guest to the show, a great friend of The Income Generation, as well as a very close friend of yours truly, David McAdams, president of McAdams Group in Memphis, Tennessee. He's a well-known financial educator. David, thanks for being back on the show.
Yeah, thanks for having me back.
So, talk to me about this. Next 18 months, recession or no recession? What's your best guess?
My best guess is that we'll start entering one within that time frame. Basically, with the inverted yield curve, some of the trade war things that are still unresolved, and frankly, a lot of other global factors, I think it's more probable now than it was 5 or 6 years ago.
What do you think the biggest factor is of all those things you just mentioned right now? Is it all the global indicators? Is it the trade war? Is it the flat yield curve? You know, if you had to pick your battle and just fix one of those three things, if you could wave a magic wand, which one would you fix first to try to prevent a recession?
Well, the short answer is yes, all of them. But, you know, we identified over 23 bubbles, both domestic and global, that have formed over the last 10 years. But I think one of the leading indicators is that inverted yield curve. And as far as fixing it, I think it's problematic because, you know, a lot of people that are saying that a recession is not probable, or they're kind of back-talking that, walking it back. Those are the same people that were saying that a recession was not going to happen in 2008. And I think the inverted yield curve happening, we've had 6 of those, and the last 5 times they all led to recession. So what can they do? Well, they could lower interest rates, but there's not a lot of ammunition there to do that.
Okay, so 45 seconds. How big do you think the stock market drop could potentially be if they don't fix this stuff and we do have a recession?
Well, I think it's highly probable that the next drop could be worse than 2008, but I'd be shocked if it's not at least 30%. And my fear, of course, that it would be 40 to 60% or even worse.
Yeah, so 30% puts us right down, Dow below 20,000, but you're saying worse than the last one. And I assume that's on the premise that a lot of times the drops get sequentially larger when you're in a secular bear market, as you and I talk about all the time. Is that correct?
That's correct. Historically, there's usually 3 drops in a secular bear market. We've had 2. I hope and pray that it doesn't happen, but there's a lot of historical evidence that suggests that we could be still in that secular market cycle.
Well, I'm going to be knocking on fake wood right here in the studio. Dave, stay with us for a moment. We can take a commercial break. And you stay with us too. We'll be back here on The Income Generation. I'm David Scranton, and we'll be back in a moment. Welcome back to The Income Generation. I'm David Scranton. I'm here with our very good friend, David McAdams, president of McAdams Group in Memphis, Tennessee. David, thanks for sticking around.
Thanks so much.
So, all right, you think the recession is likely here. Maybe if the Federal Reserve could fix the flat yield curve, get the trade wars terminated and resolved, maybe we can get away from it. But I think you and I both agree it's a long shot. A recession is more likely. But some people think that the market can continue to trudge forward. Why? Because if the Fed keeps lowering interest rates, they keep doing what they've doing, they keep giving the drug of low interest rates to all those addicts on Wall Street, that the thought is that maybe the market can keep going up. But you don't seem to think that's possible.
Well, I think it's challenging because there are people out there trying to compare 2019 to 1997. If you think about it, back then, we had a melt-up cycle that continued, the market continued to surge in 1998 and 1999. But I think what they're failing to consider is what's different in 2019. If you think about 1997, interest rates were much higher. The Fed was actually lowering rates. They were actually doing things that typically stimulate the stock market to make it go up. Right now, we've been in a rising interest rate environment, and now they basically created interest rates rising too fast, too soon. The 3-month Treasury is higher than the 10-year Treasury, and it's the opposite of what was happening in 1997. I just don't see what they can do to reverse that at this point. It's
you don't
a
think
lot
this
of challenges.
Thing, you don't think this thing you and I call the wealth effect is going to get us out of it? The fact that people are feeling wealthier because their account values are up because the market's up. You don't think that's quite enough to prevent a recession?
I don't think it's enough on a national level. Again, back in the 80s and 90s, we had an aging baby boomer population, but they were in their peak earning years, and they were spending a lot, making a lot and spending a lot. Now, a lot of those baby boomers, 10,000 people a day turn 65 in America. A lot of those people are starting to play defense. They're not as excited about just spend because they know they have to make it last their lifetime. So there's a lot of differences in the late 90s and 2019. I don't think that wealth effect is going to play out like they hope.
So, most importantly, in the 45 seconds we have left today, tell our income generation members what you think they can best do to protect against all these contingencies.
Well, they should do what I tell my own parents to do. They should play defense. There's a time to play offense. There's a time to play defense. When stocks are expensive and we're in this type of environment, you dial it back, you invest for income, you buy things that are tangible and real, things that pay interest and dividends, and you ride it out. You buy back in at a lower price when prices are more reasonable.
Man after my own heart. I love it. Good words of wisdom. And David, thanks so much for being back on the show. This really appreciate you being here.
Hey, thanks for having me back.
Now you stay with us too. We'll be right back here in just a moment on the Income Generation. I'm David Scranton, and we'll be right back. I'd like to thank all of our guests for joining us for another episode of the Income Generation. I'd also like to thank you, our new and returning viewers. You know, as you heard me explain time and time again on the show, the financial markets are driven largely by emotion. Specifically, the two very basic emotions of fear and greed. Most individual financial decisions are guided by these same emotions. For much of last year, we saw the financial markets driven largely by fear. The VIX, the volatility index that is, set new records during that time. In May, we saw fear creep back into the markets driven by some of the same factors that worried big investors throughout most of last year, as well as some new factors. Another escalation in the Trump-China trade war, a yield curve that isn't partially inverted, weakening economic data, increasing warnings of a recession. Now, of course, in this new age of unprecedented economic uncertainty, that could all change by next month. Maybe the trade war will be settled. Maybe the Fed will avert the next major recession and long overdue major market correction with more artificial tricks. Again, anything's possible. But the more important consideration for investors in or nearing retirement is not what's possible, but what's probable. Why? Because when it comes to individual investment decisions, fear and greed are both survival instincts. We greedily accumulate as much as we can when we can in order to prepare for our future survival. And obviously we fear things that threaten our survival. But one of the keys to smart investing is knowing which emotion to pay most attention to at the right times in life. Greed might make the most sense in your 30s and 40s because you probably have little saved, and you have a long future to prepare for. But by your early to mid-50s, you've had time to accumulate some assets. And if something were to happen to them, you now have much less time ahead of you to recoup the loss. In other words, it probably makes sense now to pay more attention to that other emotion, the one that warns you of potential danger. And that, of course, is fear. It probably makes sense to shift your focus from risky financial strategies geared toward growth to more conservative options geared toward portfolio protection and maximum income. Why? Because as soon as you take action to address the source of your fears, you don't have to fear them any longer. Thanks for watching. If you're close to retirement and really want to know how to protect and maximize your money, it's absolutely essential that you stay informed and up to date. And as you know, right here is where you can do it on the Income Generation. I'm David Scranton, and we'll see you next week. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation.